All down. All silent. Going. Go. So congratulations.
Welcome to the Current Market Insights podcast, brought to you by Harris Partners Real Estate. Each episode, we chat with real estate author and industry leader Peter O'Malley to discuss the current property market conditions and provide insights to assist you on your property journey.
Hello and welcome to another edition of Current Market Insights. I'm your host, Kieran O'Brien, and with me as always is my good friend and co-host, Mr. Peter O'Malley. Peter, hello.
G'day, Kieran. Great to be with you.
Great to see you for another week, Peter. Let's jump straight in tonight and tackle some of the topics we've got. I wanted to kick off with just very briefly an announcement from the NSW Government this week regarding some changes to the New South Wales Public Service and their work from home policy. Obviously, a lot of businesses through COVID did provide some flexible arrangements to help people, get through circumstances that were obviously unseen in a lot of people's lifetime. And one of the things that we have talked about before is just the impact that work from home has had on, obviously, purchasing of lifestyle properties, particularly in areas not too far from the city, but also the impact it has on, commercial real estate within the city itself, and I guess the vibrancy and energy of city locations. And particularly given you've run a business, obviously, through COVID, and you've had to see a bit of both sides with your own teams. What are your thoughts on this change from MINS? Do you think it's positive, and do you think it's likely to have any real impact on property, in terms of forcing people back to a city location?
It'll have an impact for sure, because it'll help recalibrate the market back. I don't think we'll ever go back to where we were pre-COVID, but it is another adjustment back to some normality, if you like. So coming out of this is, I think, properties that are distant from state government infrastructure, people that who work from home and live a long way from their state government job will be disadvantaged, and clearly the owners of the buildings that they're going to work in will be advantaged. So whether that's investors or investment funds or whoever may own these respective places of work that will now suddenly have increased number of people attending them each day, they will increase. And we've probably seen this issue played out most dramatically in America, where it's really common to see office towers that have sold for $200, $300, $500 million in days gone by reselling for a fraction of the price that they previously traded at, because the work from home phenomenon is so acute there in America. So after COVID, a lot of people, particularly the private sector, did get back into office and out on the roads. You can tell that certainly Tuesday, Wednesdays and Thursdays are a office day, and Mondays and Fridays tend to be a work from home days because the traffic's a lot freer. But we are going to clearly see an increase in people on the roads again.
Do you think then we'll see any real shift in regional markets as work from home becomes a little less palatable for organisations as big as, say, the public service? Do you think there may be a bit of a shift in terms of the trading numbers and activity in those locations? You have said once before to me that you think that market has obviously slowed quite substantially.
Yeah.
Do you think that it's likely now to flip the other way, where people are saying, well, I can't actually live in Kiama, or I can't live somewhere on the Central Coast anymore and commute 3 or 4 days a week because it's just not practical?
I think that's a big part of it. That's right. Now, if the employment market stays tight, those people may opt to take a job closer to home. So they're not without choice. But if unemployment were to rise, and then suddenly those people deeply value their government job, and they deeply value it to the degree that they're prepared to move house to keep it, that's when those markets, those fringe markets, do become under pressure.
Yeah, certainly makes sense. I must say, on a personal level, I think this is quite a good move. I know as a taxpayer, I like the idea that people getting tax dollars for their job are actually, in the city doing work as opposed to whatever happens at home. And I certainly don't disagree with the work from home environment. I think it can be beneficial in some cases, but I certainly personally think for public service jobs, it should really be in the office with the rest of your colleagues getting stuff done.
During COVID, most businesses accepted and were surprised at the beginning of COVID that people were more productive at home than they were in the office. And that was one of the surprising elements of work from home at the beginning of COVID. But let's not forget that at the beginning of COVID, we were locked down, so there wasn't there weren't other distractions that would normally exist in a free society. So to keep sane and keep productive, and nobody knew what the future was going to bring, so you really didn't want to be seen to be dragging the chain with your colleagues. Everyone worked, really, really intensely during that period to stay up to scratch. But now that we do enjoy full freedoms, there's no doubt that productivity is being lost. And whether it's the repairman coming around to the house, or I've got to get the dog to the vet, or whatever it might be, I think this is an admission that is not as productive having people work from home full time. And the private sector made this change. When was it Elon Musk called everyone back, and he was sort of the first person to lead on this, and then everyone criticised him and then followed suit. Was that 18 months ago?
Yeah, 12, 18 months ago.
Yeah, and now here we are with the public service doing the same. So it's an unsurprising move for mine, but you will notice some changes, and some of those regional remote markets might be under a bit of pressure, and you'll notice peak hour traffic will become more intense and over 5 days a week potentially, as opposed to just those 3 middle days of the working week as it seems to be at the moment.
Yeah, it certainly gives people food for thought in terms of purchasing locations, access to public transport, that kind of thing. As we wrap up this discussion, Pete, I had to laugh reading about the story. The Premier of Victoria had something to say to the opposite to Premier Min, saying, no, well, why would you bring everyone into the office? And his retort was basically, after all of your lockdowns, I'm surprised that Victorians don't want to get out of the house down there and get back into the office.
Well, the line that I read is that she was inviting people who did want to work from home to move to Victoria.
Correct.
I can tell you one thing, it'll take a lot more from working from home for me to move to Victoria, but let's move on, shall we?
Let's move on. Look, our main story tonight really is the Reserve Bank's decision. We met last week, you and I, and we spoke about the CPI numbers that had come through and the impact that we thought that may have on the RBA's decision this week. Obviously, they've now, the board has met, they've released a statement, they've made a decision on the cash rate. Why don't you take us through, Pete, what the governor's come to and what that really means for us?
Oh, well, let's talk about the bank we're meeting over Monday and Tuesday. Let's talk about Monday. The Japanese stock market dropped as much as 15% and then finished down 13.5% on Monday. On the same day, the South Korean share market dropped as much as 11 or 12% and finished down 10% for the day. So when the RBA went in to meet on Tuesday, notwithstanding they make their announcement at 2:30 on the Tuesday, but they would have been meeting on the Tuesday morning, and whilst the Japanese share market did experience a nice bounce back on Tuesday, the reality for the RBA is that when they were making their decision, the Japanese share market was clearly experiencing margin calls, dropping 15%. We still haven't, at the time of recording, seen what response Iran will have to the assassinations in Tehran with Israel. So that is all this is mentioned in the RBA statement, geopolitically. So the RBA had a lot to consider on Tuesday, not just the local inflation data. So they mentioned all of that in their statement. And going from the top, they said inflation is proving persistent. And the reason we read or cherry pick these statements, Kieran, is because when you read the commentary, every economist seems to suffer from some form of confirmation bias, where they pick out of these statements what it is that what they think feeds into their circumstance. And there's some high-profile economists at the moment that were trying to suggest the RBA would somehow cut rates on Tuesday. And when these minutes came out, other economists said that statement signifies the RBA was so close to increasing rates that it's not funny. I think that's a little bit of jawboning. I don't think the RBA were ever going to increase on Tuesday on the backdrop of Iran lining up to tackle or attack, I should say, Israel, and a Japanese share market dropping 15% in one day and finishing down 13.5% for the day. So they played it safe and they held, and they said inflation is proving persistent, and quarterly underlying CPI inflation has fallen very little over the past year. In central bank terms, they're bemused at the inflation rate.
Yeah, certainly. I did read the statement that was released, and one of the things that kind of stuck with me was talking about how the forecasts kind of indicate that they think, or the bank at this stage think that inflation will fall back within target range by the end of next year, which tells me that, one, they're certainly not looking to cut rates anytime soon with that on the horizon. or potentially, coming at a later period than they would have hoped. But it also indicates that it is sticky. They're playing their hand very carefully, and I think they're trying to take very measured steps to not either over or undercorrect here and put us into either a massively deflationary period like you mentioned, or let inflation run again. They're certainly, as you say, they're a little bit unsure about what the events are going to be and what impact they're actually going to have on our local economy.
And that's why they say data has reinforced the need to remain vigilant to upside risks to inflation, and the board is not ruling anything in or out. And that's been their repeated line over the last few meetings. They say that policy will need to be sufficiently restrictive until the board is confident that inflation is moving sustainably towards the target range. The nuance here is there's been some people that have called for preemptive rate cuts like they have in Europe, but the RBA seems to be ruling that out in that line by saying policy will need to be sufficiently restrictive until the board is confident that inflation is moving sustainably towards the target range. So I'm reading there that until they actually see the inflation rate break to the downside from where it is, there's no chance they'll cut unless there was a major geopolitical event, which nobody wants, of course.
Yeah, look, I certainly read the same. I think, saying sustainably to me is at least one CPI cycle, if not two, before they're confident that actually we're trending in the right direction, as opposed to just, an erroneous win in the inflationary battle.
Which, if you're saying two and they meet every 6 weeks, that's 3 months. So what that's suggestive of there is that if you were to follow that train of thought, that you won't see a rate cut until early next year.
Yeah, correct. And again, going back to the other statement that they don't expect target inflation to be back within range until the end of next year. I'm not even sure that the start of next year would be the start of rate cuts. But again, who knows, and things may shift around certainly. In terms of the cash rate staying on hold, we've spoken about before how a cash rate hold for many people is the same as a rate rise. We have been reading a little bit on and off about the increase in distressed sales across the market. And in fact, I've started to see some advertising on social media from some companies saying, hey, if you're distressed, we can help you get out of the situation now, which indicates that, there's obviously some opportunists out there looking for this. Do you think that this rate hold is going to add a bit of confidence to the market? Or do you think...
not at all. Not at all. It won't punish the market, but it doesn't add confidence to the market. It's no form of stimulus because you can't have a setting that's restrictive and adding confidence in the one go.
Yeah.
Basically, there were a lot of people that were flinching for the hammer blow on Tuesday that didn't come, and they're immensely relieved, and it's a reprieve. But yes, it is what the RBA think it may be and what they're hoping it may be is what we've discussed in the past, that the current setting is the terminal rate. That's what everyone's hoping. The terminal rate is the rate at which it brings down inflation without the need for further rate hikes. And the RBA giving the economy every benefit of doubt to prove that we are at the terminal rate, but if inflation does tick up, they will have to dial up interest rates again. That's what they're saying. They did, to your point about people adding distress and seeing things on social media, they added some really interesting commentary on the economy in this statement. And one of them read, the momentum in economic activity has been weak as evidenced by slow growth in the GDP, a rise in the unemployment rate, and reports that many businesses are under pressure. And there is a risk that household consumption picks up more slowly than expected, resulting in continued subdued output growth and a noticeable deterioration in the labour market. They also go on to touch on a point, Kieran, that we have spoken about in previous episodes. Geopolitical uncertainties remain elevated, which may have implications for supply chains. And when we met with Louis Christopher mid-year and said, tell us about what the market looks like heading towards the end of the year, his number one thing to watch was the geopolitical space and the overspill of that. And we said this same thing last week, of course. And here we are this week, and the RBA are highlighting that as a major issue in this month's statement.
Yeah, I like to think that the RBA listens to our podcast week to week, Peter, and gets a bit of inspiration for their meetings.
Louis. I don't think they're listening to us.
I'll make sure I send them an edition to have a listen to. As we sort of wrap up on the RBA's decision, I guess the most salient point that I want to try and elicit for our listeners, given that we've spoken about heading into the spring market, we're expecting an upturn in activity in the property sector. Do you think this decision is going to have any substantial impact on the number of listings that we see coming to market over the next few weeks? Is it likely to hold some people off that may have thought they may have to go on market? Or do you think that we're probably already started the cycle and people are set to sell already?
Look, I think there would have been more stock coming to market if there was a rate hike. There's no doubt about that. And I think the reason that the RBA are so hesitant to increase rates where they happily did it, for want of a better word, earlier in the cycle, is they know if there is another rate hike, it is going to punish people severely. They've said as much. They know the pain another rate hike would cause.
Yeah. Well, we can only hope that inflation comes under control and we can sail onto smoother waters for the rest of the year and into next year.
Yeah.
Look, to wrap up tonight, Peter, as always, I'd love to get a bit of a market wrap. We've had pretty stable results over the last 4 weeks through Louis' numbers. So if you can, run us through what happened on the auction side across Sydney this week.
Yeah, look, on Saturday, SQM Research have turned in a 49.5% auction clearance rate, Kieran. And on the midweek auctions, they had a 52.4% auction clearance rate, giving us a weekly clearance rate of 50.2%. So 50.2% auction clearance rate is pretty decent, but there's an interesting number that I want to draw people's attention to, and that is that of the total scheduled auctions, 814, 79 were rescheduled. So that number's popped in recent months. And rescheduled auctions means basically, Mr. and Mrs. Vendor, we've got an auction scheduled for Saturday, August 10. We don't have enough bidders. I don't want to withdraw it from auction. That's playing off the back foot. Let's give the property the benefit of the doubt. Let's just redate the auction until 2 Saturdays' time. That has happened with 10% of all properties going to auction in the last week, where there's insufficient interest, but the agent's confident enough to persist with the auction process and encourage their vendor just to give it a few more weeks. So that's not popping up in the auction clearance rate. So we've got to ask ourselves a question now. Is the agent kicking the can down the road to their ultimate detriment, or are they smoothing out the extra supply that's coming into the market, trying to sell the properties off in an orderly fashion? If they're kicking the can down the road to their client's ultimate detriment and they're pushing the auction back closer to spring, and that coincides with a wave of spring listings, you could see the real auction clearance rate drop noticeably below 50% if that were to happen. So it's a really pivotal point in the market for mine, because clearly if you're having 10% of all auction properties, aside from the fact that of those that are counted as auctions, there's a 50% clearance rate, 10% of the overall number is itemised out as being rescheduled, and we'll push that down the road. You may see a oversupply issue in early spring as the late winter unsold stock clashes with the incoming spring stock.
Yeah, certainly. I think it'd be an interesting testament to the skill of the agent, because the experienced skilled agent may very well know that this is the best move to push it forward and get that sale. Whereas an inexperienced, unsure agent may just say, well, quick, we'll give it a bit more time and see what happens, and may ultimately lose for their vendor, as you say.
And look, a vendor is more likely to look at a sale in June, July and say, well, look what that sold for just a few weeks ago. My house is equal, my house is better. You get the message. Therefore, you should be able to achieve. Therefore, just push the auction back, and I'm sure a buyer will turn up and pay what the people got down the road in June or July. But the thing is the people that were on the market in June or July may have been competing against far fewer listings than what the vendor will be competing against in late August, in early September. In our newsletter this month, we talk about 5 messages to help you sell for more this spring, and the number one point was monitor stock levels in your market niche, because in the short term, it won't be interest rates that determine the success of your sales campaign. It'll be competing listings in the market.
Oh, certainly. As we wrap up then, a couple of interesting things I thought from this, Peter, and I'd love to get your thoughts on. This week, the combined number sold under the hammer, for the first time that I can think of in recent memory, was higher than both the before and after auction sales. which usually I think we tend to see a bit more sell either before and after as opposed to under the hammer. So for me, that was interesting. But I can't help but point out also that 2-3 weeks ago, we mentioned that midweek auctions were far less effective, and this is the second week in a row where the midweek auction clearance rate is actually higher than the Saturday one. So I feel like you have unleashed a curse on us.
That's
with
right,
that
gone off
commentary.
a bit early there, eh?
Oh, it's okay. It won't be the first one we'll lose, I'm sure, this year.
I was just going to say about that point about more selling under the hammer. As a real estate agent, you've got a wave of vendors and they're not fully accepting of the messaging that you're giving them because the vendor is looking backwards at the sales that were pretty strong in June and July. The real estate agent is looking forward or dealing in the market reality of the day, which is sort of, it's better for some properties than others. That's the other thing at the moment. We've got some listings that are really hot at the moment, and we've got some listings where we kind of can't believe there's not more interest in them. The reason agents love the auction system is they advertise the property below market price. They say there'll be an auction and the price will get to where it gets to on the day, and that's market price. And then they stand in the courtyard with their vendor and say, there's 3 bids out in the courtyard. This is what the market's telling you. You take it or leave it. What do you want to do? And vendors under those conditions might be saying it's less than we wanted, but the agent's got 3 bidders here on the day. We'll grab it and run. We don't want to persist with the process.
Yeah, we certainly don't have to go into the details again about the amount of time and money and emotion invested in a campaign before it gets to that point for many sellers.
Oh yeah, well that the agents love the sunk cost syndrome that a vendor goes through because the vendor's chasing the outcome at the end, and if the vendor's chasing the outcome more than the real estate agent is, provided there's some genuine buyers there on the day, it'll sell.
It's a sale. Look, really great chat today, Peter. As always, I think we've hopefully simplified some of the complex financial stuff that's going on and tried to give people a better sense of the market. I really appreciate your time, and I know that our listeners do as well.
Hope so, Kieran, because I'm more confused than ever at the moment, but there you go.
There you go. Well, look, thanks to everyone for listening to Current Market Insights. We look forward to speaking with you next time.
Thanks for joining us on the Current Market Insights podcast, brought to you by Harris Partners Real Estate, the podcast providing real estate insights you won't find anywhere else.